Thank you all for joining us today. This is going to be a great and interactive session with Ted Howell. My name is Annette Tonti. I'm the Managing Director of RIHub, and we produce overall the Rhode Island Startup Week. So we're very excited to be here today and bring you Ted. So if you are starting a business here in Rhode Island, you absolutely need to know Ted Howell and his associates. And I'm not saying that as a commercial or an advertisement. It is the number one thing that startups and entrepreneurs can get wrong and actually cause a tremendous amount of damage. It's far more complicated than any of us as entrepreneurs want to think. And it affects not only your day-to-day in terms of contracts, employees, et cetera, but your future in terms of transitioning your company, whether you sell it or go public. Wouldn't that be great? So let me introduce Ted Howell. He's a mechanical engineer turned lawyer, which is actually an important point because he uses that kind of background to focus on advising entrepreneurs around relating to formation, management, protection of assets, financing, and sale of the business. We're going to talk about a bunch of that today. But his approach, because of his engineering background, really helps him take complicated problems, because a lot of these legal things are very complicated, and move them into something much more simple that you can actually handle, and it's more manageable. So he's at the peak when he's brainstorming with his clients about various legal and business structures or strategizing with respect to the negotiation of the transactions. So by the way, he is a founder and runs Howell Legal here in Rhode Island. He has two partners, but actually 4 associates. One of them is actually in Austin, Texas now, which is great. They're growing. If we do not get to all of your questions, please put your questions in the chat today. If we don't get to all of them, I know Ted will be available to answer questions further. So without further ado, take it away, Ted.
Awesome. Well, hello, everybody. And thank you, Annette, for that awesome introduction. I have a lot to go through today, and now I have a high bar to meet in terms of trying to simplify something that's actually pretty complicated. I'm going to talk today about convertible notes, SAFEs, and Series Seed equity, and I'm actually going to, I've got a slideshow prepared for you guys. But as Annette mentioned, this is something that's supposed to be highly interactive. And so I do, go ahead and ask questions of me as we go along. I have a lot of information, so I may not be able to get to everything. But do please feel free to ask questions. Moving along, let's see, is everybody seeing the slideshow? Excellent. All right. So I focused today's conversation on 3 different types of typical early stage investments. One being preferred equity under the standard Series Seed documents, which is a open source document that anyone can look up free of charge. Convertible notes, which are very prevalent. There are some open source forms that you can look up if you'd like, and I'm happy to give you some of those if you're interested, as well as SAFEs. And what I'd like to do is go through some of the differences between these, some of the shared characteristics, and some of the things that we're looking for as a company or investors might be looking for in terms of their investment. So kind of getting into company considerations as it relates to all of these things. The types of things that I'm going to be focusing on are the impact on each of the founders, and I include in that list of founders people who are existing shareholders, and their share of the company, the impact on the company's ability to negotiate future rounds, because whenever you're granting equity, whenever you're doing anything in the early stages, you're constantly thinking about next steps and future steps and trying to make sure that the company's in a position or in the best position possible to be able to get further investment down the road. The cost of completion, that's an area that has become a very high priority, obviously, for early stage startups, because a lot of them either just have friends and family money, some excess cash from founders, They don't have the cash yet that may be necessary for a more sophisticated type of investment vehicle. The administrative burdens to maintain the investment to the company, because those involve future costs. They also impact the ability of the company to operate. The impact on the management of the business, because a lot of founders don't want to relinquish control. And inevitably, sometimes that's exactly what this results in. And also another really important factor that is often forgotten by companies is when the money's paid in. It's actually quite frequent that we see investors that propose to commit to pay a certain amount of capital over a period of time, and if certain milestones are met, and that's a real problem for the company in some circumstances. So the long and the short there is that we usually push to try to get the money paid in at closing. And the other thing that, the flip side of the coin that we need to look at here are investor considerations. And typically, what an investor is looking for is, a percentage of the company that they want to obtain. They're usually quite concerned about dilution, and dilution in terms of an investor isn't really about how much their percentage interest is actually reduced, but it's actually a dilution in value of their investment. And there's actually a big difference there that you as founders need to understand. It's not infrequent that I've seen founders of companies grant quote unquote anti-dilution protection, where they're actually ensuring an early stage investor that their percentage in the company won't go below a certain level. And unless there are some serious constraints around that in terms of how long that covenant will last, and in terms of appropriate constraints around the percentage level, those can be very problematic for a company, because they have somewhat of a ratcheting effect. And eventually what they end up doing is really diluting the founders quite considerably. So when we're talking about anti-dilution, as we go through these provisions, what we're actually talking about is the value of the investment that the investor has received. And the only time anti-dilution typically would kick in that circumstance is if the company has a later round of investment at a lower valuation than the one that the investor had come in on, and that's called a down round. So that's an important point to remember. The other thing that investors are typically concerned about are control over and/or visibility into the company's operations to protect their investment. And in this circumstance, it's really incumbent on the investor, not the investor, the company and the founders to be comfortable with the investor. In the long term, especially those investors that are larger investors will be playing a larger role in the company. They will have voting rights. They will have visibility into what you're doing. And so it's very important that you are teaming up with investors that are not only along for the ride to make money, but are also completely aligned in terms of vision and how you plan to execute for the company. Investors are also usually very concerned about their ability to participate in future rounds. That's something that we typically see called pro rata rights. And in that circumstance, the investors want to make sure that once they've made an investment in a company, that they're able to sort of double down on their investment and put more in if in fact the company starts to show signs of serious success. Some of the other obvious considerations are their ability to recoup their investment, but that plays in multiple ways. That's not only being able to recoup their investment if the company is sold or dissolved. But there are some situations where the type of instrument used may actually allow them to try to recoup their investment at an earlier time, perhaps at a time that's not good for the company. And that can be pretty troublesome to a company. And I'll go through some of those as we go through some of the key terms that I want to discuss.
Ted, just real quick, somebody asked, hey, when you say early stage, are you talking about pre-seed and seed? I know there's a lot of words that have come up over the years now that, kind of people like to talk about like where they are in time.
Yeah, I mean, I generally use it up through Series A, right? So it may even include an equity investment, but I generally think of that as through Series A. And then, and one of the less obvious investor considerations as you go through term sheets is a good investor actually wants to make sure that the founders and team members remain motivated. And so I don't want you to leave this discussion and think, hey, investors are out there just to get as much of the company as possible. I've actually seen a lot of situations, especially with good investors, where they're keenly aware of the fact that the founders may have a low amount of equity, and they're very concerned about making sure that those founders have a sufficient stake and skin in the game, so that they have the ambition essentially to push forward and the motivation to push forward and do what they need to do to make the company successful.
Hey, before you move on, it seems to be there's a few other questions in the chat. I think what happens is terminology gets thrown out, and I think we all sort of batter it around and try to figure it out. And so there's some discussion about, the expectations maybe that define like pre-seed versus seed in terms of investors, like what are their expectations? If that's something that makes sense.
Yeah, I mean, I don't, to be honest with you, I don't get too hung up in that nomenclature.
Right.
And it's a difficult thing for me to answer. And I suspect that the investors themselves probably look at it the same way.
Yeah.
In terms of no matter what you tell them, if you're pre-seed, seed, or otherwise, they're going to want to get an understanding of the company and a feeling for where they are in the growth cycle themselves, and make that determination accordingly. So that's sort of a long-winded way of saying, can't really answer that question. And it's one of those things that there's sometimes when you see it, it, and there are sometimes when they're not, they're kind of outside the box, especially in circumstances where a company had a significant amount of its own capital, to invest in its own growth. That's a situation where you actually start to see investors might undervalue the company, and the company might need to take steps to show, no, we're not quite as early as you thought we were. Does that help?
Yes, thank you. And I also, add it really does matter. Every business is a little different in terms of where you are and how the investors will think about it.
Yeah. All right. Should I move on? All right. Awesome. So I'm inserting this slide in here just as almost a cautionary statement. The speedometer's there because with the prevalence of all of these online documents and open source documents, we find a lot of companies that go out there and they negotiate their own, usually a convertible note or a SAFE themselves. And they go through the transaction and they come to us later on after the fact and they say, okay, well, we've got these outstanding. And when we start asking questions, quite often we start finding some problems. And so there are several things that you need to know specifically about convertible instruments, because convertible instruments is the usual type of investment that is going to be prone to this. And so some of the assumptions that you need to know is that convertible instruments, and I'm including that convertible notes and safes, they assume that there's going to be a price round in the future. So they're not a good investment vehicle if this is going to be your sole investment in the company, because the whole mechanics of them are driven around the concept that they will be converting into equity at some future price round. So that's one of the important points. Another important point is that if there are caps on convertible instruments, not all convertible instruments have caps, but what a cap is a valuation associated with that instrument. It ensures the investor a valuation that is no higher than whatever that cap level is set at, and therefore ensures that investor a minimum percentage of the company. And it's really important to understand that if those caps are low, the terms of convertible instruments can be more beneficial to the investor and more detrimental to the company. And so when we're talking about negotiating these instruments, if there are low caps, a convertible instrument may not be the best instrument for you to use. It's also really important to understand in the negotiation that convertible instruments are, I don't want to say they're disfavored by next round investors. They're not. But the next round investors will require all convertible notes, and typically all safes as well, to convert into equity at the time of the next round. And the reason why they require that is because convertible notes especially would take precedence in payment if the company were to go bankrupt or dissolve or whatever else. They would take precedent over those new investors' payments in the equity. And one of the prime rules of investing in a startup is that last money in, meaning the last investor coming in, wants to be the first money going out. They want to take a preference over anybody else who was previously a shareholder or an investor in the company. So convertible notes are likely going to have to be converted, as are safes. And there are terms that can be negotiated in those documents that can make it difficult for the company to force conversion and give the holders of those instruments some leverage in that next round. So it's important to keep that sort of in the back of your mind as you're considering convertible instruments. Next point, they are securities. And what I mean by that is, just like stock in a company, is they're subject to compliance with both federal and state securities laws. And a lot of early stage startups, new companies, new to the startup world or investing, don't even realize that there are these securities laws out there. And anytime you're issuing convertible notes, safes, as well as stock, there needs to be an appropriate exemption under applicable federal and state laws for that issuance. Otherwise, you could have some problems down the road, including having to pay back all the funds that came in, and worse. Corporate formalities still apply. So, what you don't see on those open source forms is the fact that there have to be director consents or shareholder consents and the like to properly authorize those transactions. And then finally, and this is especially true of convertible notes and safes in LLCs, there are potential tax consequences that need to be discussed with accountants and or tax counsel. And I realize at this point, I probably ought to do a quick reminder of what the difference is between a convertible note, a safe, and of Series seed equity. And yeah, so So for those of you who don't fully understand what I'm talking about when I say convertible note, SAFE, and seed equity, I'm going to start with seed equity, Series Seed preferred equity, and what that is actually just stock in the company, but it's stock of a new class that entitles the holder of that stock some preference over the existing shareholders. And usually that preference is in the form of, hey, if you sell the company or if the company dissolves, then I get paid first as a preferred shareholder up to the amount of money that I put into the company. It can be some other determined amount, but it matches the amount of money that they put into the company. Those investments typically involve a bit more negotiation, a bit more work, and involve more transaction costs. And so this concept of convertible instruments has really come in vogue in the last, I'd say, 15 years or so. And what they do is they instead, and I'll start with a convertible note, it instead is like a loan, right? It's a loan to the company. If somebody's investing, say, $20,000 on a convertible note, what they're saying is, I'm going to loan to you, the company, $20,000. But if at some point in the future you have an equity financing, i.e. a sale of Series Seed preferred stock or some other form of stock to investors, then I'm going to be able to convert that note into the same equity that you're giving to those other investors. And typically, I'm going to be able to convert it either at a discount to whatever they're paying for it, a typical discount being 20%, or at a set valuation, which is the cap that I described earlier. So it's a means of putting off the decision as to valuation until some future time. It's also a pretty cost-effective instrument to use. And for the investor, by virtue of it being debt, they're getting a preference over the shareholders of the company at law, meaning that if the company were dissolved or sold, they'd get paid first. And they're also getting the benefit of terms that are going to be negotiated by future investors and potentially like a lead investor. So they've become incredibly popular. A SAFE is essentially the same thing as a convertible note, except it's no longer considered a debt instrument. And that distinction is pretty important in several ways to the company, and it can be very favorable to the company. In particular, all it is it's a right to obtain future stock in the same manner that I just described with a convertible note, right? It happens at the next round of financing. The amount invested converts either at a discount or a cap. But unlike a convertible note, there's no interest associated with it. They're also, since it's not a debt, if the company were going into bankruptcy, it would be treated as a contractual obligation, which still takes a preference over stock, but is subservient to other debt. And the other important factor about it is that they're very simple and they're very easy to put in place, and so they tend to be less expensive for the company. So with that, I've already gone into this a little bit, but I want to talk about some of the different points as they relate to each type of instrument. So a convertible note, a SAFE, as well as Series Seed equity. And the areas that I really want to discuss are valuation, repayment obligations, liquidation preference. And that liquidation preference, again, means whether or not the investor's entitled to get paid before other people. And that relates to both amount of liquidation preference and their seniority over other people. Control future participation rights of the investor, so their right to participate in future rounds. anti-dilution, and transaction costs. And I am looking at my time here and realizing I don't have all that much, and I've got kind of a complicated comparison here. Debating, Annette, I may just kind of move on to some conclusions here to try to move things along.
I think that's good. And folks can, certainly put information in the chat. I also want to mention to everyone, this is being recorded and we will share it again in case you want to take notes later and rewatch.
Yeah, and I'm happy to share this comparison that I put together because I think it can be helpful. What I've done is I've generalized terms that are seen in all these instruments. They may be called something different in each of the instruments, but they're generally seen in all of them. I put in what typically you as a company founder might like, and what would be the best instrument for you as a result. And I also put in what an investor typically wants or might be looking for, and therefore what instrument might be the best for the investor for that particular term. But I'm going to jump to sort of these summaries because I have sort of instances where SAFEs are the best option for the company, as well as convertible notes, as well as Series Seed equity. And typically, well, I will say right off the bat, if you are able to do sort of an early stage investment in the SAFE, a SAFE is probably going to be, no pun intended, one of the safest vehicles for you to use, and one of the most beneficial to the company. But the types of circumstances that I'm usually looking at where I really want to use a SAFE are where there's no lead investor, like maybe there's friends and family involved, parents, small investors, people who aren't necessarily looking to lead an investment, to go in and try to really understand the company, negotiate terms the way you would need to for an equity investment. A situation where there's no agreed upon valuation or cap. And that's important because of a point I made earlier that obviously if they're strongly negotiating a valuation or cap, there may be circumstances where a SAFE could be detrimental to the company. Investors are friendly. I'll say that's the case for all investments. But in this case, I especially bring it up because there are a lot of investors who just don't want to use SAFEs. They don't feel comfortable with it. And so you've got to make sure that you've got somebody on board who is comfortable with it. And the proceeds are too low to spend on the transaction costs. For convertible notes, everything is the same as SAFEs for a convertible note, except it's a situation where the investor doesn't want to use a SAFE and they'd rather be in a convertible note. And that certainly happens. So, there are times when you'll go out there with a term sheet for a SAFE, very basic terms, and the investor will say, I like those terms, but it needs to be in a convertible note because they want the comfort of knowing that they're actually holding a debt instrument. And then where Series Seed is the best option is a situation, as I mentioned earlier, where there's a lead investor to negotiate that valuation. And potentially those investors are requiring a valuation cap that's pretty low. And again, the reason for that is that in a convertible instrument, if there's a low valuation cap, there's several reasons that can be detrimental to the company. A, the investors, by virtue of those convertible instruments, are getting anti-dilution provisions that are better than what they would ever see in a preferred stock financing scenario, or at least in terms of marketplace terms. But B, and this is something that's really important to understand, and I wasn't able to go into in the comparison. One of the big distinctions between SAFEs and convertible notes and on the one hand and preferred stock on the other, is that SAFEs and convertible notes convert into an equity that is on par with the next investment. If you remember earlier on, I said that most investors want to make sure that they're senior to all prior investors. But the way a convertible note and SAFE work, they convert into substantially the same security with some exceptions as the preferred equity investors. And as a result, they're on the same footing. And if you have a low cap, a cap that's significantly lower than what you're trying to negotiate in that next round of financing, that can be very problematic for your next round investors. They essentially say, why am I giving these early investors such a great deal on the stock that I'm buying? I don't want to pay as much. And what it's going to result on is what I like to call an anchor on your valuation. It's going to essentially make it harder for you to negotiate a higher valuation in that next round of financing. And so when we see low valuations, we tend to try to push potentially towards a Series seed investment instead of a convertible note or a SAFE. And then the other part of it is that it needs to be a big enough transaction to cover the transaction costs, which it shouldn't be that great if you're using the standard Series C documents, but will naturally be a bit higher. It's also important to know that when you're negotiating preferred equity financings, is fairly typical for the company to pay the investors legal fees, whereas in convertible notes and SAFEs, it's not. And so there's sort of this double whammy on transaction costs that happen with preferred equity financings. I'm going to go to this slide, which I think is important. Where do founders typically get tripped up on each of these instruments? And the areas that we've seen a lot of problems for each of the instruments. In SAFEs, it's going to be the valuation cap. That's something I already described. By the way, I should say that not mentioned here, but should be, is securities law compliance. That relates to, as I mentioned earlier, that relates to all of these vehicles. So that is an area where companies, especially if they're trying to do these instruments on their own, will get tripped up. But with SAFEs, the other place is valuation cap. And then the other place I put in here, size of investment and number of investors. And that's something that I see across the board. One of the fundamental things that we advise our clients on is to try to have a fewer number of investors with larger investments rather than a large number of investors with small investments. And one of the rules of thumb that I've used is that, something like, 5 to 10% of your shareholders are going to be problematic and are going to be difficult and somewhat of a thorn in your size. And so the higher the number of investors that you have, the higher chance that you're going to have more than one of those thorns in your side. But perhaps even more importantly, the administration of closing the deals as well as future deals, it's almost like a logarithm. It's amazing how much more time is required to complete these actions, and therefore how much more cost the company incurs as a result of increasing the number of investors. And there are tools out there, things that like roll-up vehicles and otherwise, to try to reduce the number of investors. But it really goes across the board, even to things like there's capitalization table management software like Carta, and they bill you based on the number of investors, and it's not an insignificant amount. And so the difference between 10 investors and 50 investors just there can be thousands of dollars a year. And and the amount of headaches, you add the amount of headaches and everything else, it's just, please try not to take small investments from a whole bunch of investors and limit it. On convertible notes, we have kind of the same issues with the valuation cap, the size of the investment and number of investors. But one of the, a couple of other terms that you see in a convertible note that you don't see in a SAFE include this qualified financing threshold, the maturity, and what I call shadow securities. And all of these relate to concepts that I've already touched on in this presentation. But what a qualified financing threshold is it's a threshold beyond which the investor, the holder of the convertible note, has to convert in the next round of financing. And investors like to have a high qualified financing threshold because they want to make sure that the company isn't going to do like a sham transaction, like bring somebody in for $10 at a really high valuation and force the convertible note to convert. And so what they say is that, yes, we will convert, but we'll only convert if you bring in, say, $1 million, right? You want to make sure that that threshold is low enough so that you don't get stuck. I've had several nightmares where we've gotten stuck and the convertible note holder has held out and tried to get more of the company than what they were entitled to under the convertible note, and or we run into securities laws issues. So when you see that term on the term sheet, and don't just put in the number. I've actually seen some founders put in a number trying to impress the investors, saying, well, I'll make it high so they'll know I'm ambitious. And no, that's the wrong thing to do. Make it low. I try to make it, $500,000, half of what you would think you might take in your next equity financing. In terms of the maturity date, this is another one of those problematic terms in a convertible note that everyone needs to be aware of. And by virtue of being a note, a convertible note has a time certain where the company has to pay the amount of money that's been invested plus interest if it hasn't already converted to stock, and that's called a maturity. And that can be a real problem for the company because usually once the company's taken an investment, it's spending that money, so it doesn't have that money anymore. You want to make sure that you have a maturity date that goes far enough out so that you can be relatively certain that you're going to complete that qualified financing before the maturity date. In reality, a lot of investors are friendly and they'll go ahead and they'll extend that maturity date. But a couple of holdouts can be a real problem. It can actually throw the company into bankruptcy. And to that point, I should mention here, although it's not in the slide, another pretty standard feature in a convertible note is to make sure that the individual investor's consent isn't needed to amend it, but instead a majority of the convertible note holders by dollars invested can actually amend it, because that's the clause that we usually look at to override those holdouts and keep the company on sure footing.
Hey, Ted, can I ask a question from the chat? So
Yeah.
by the way, if anybody is not sure right now that this is not a topic you can cook up in your own kitchen, that you actually need to talk to Ted on these things, I think you made your point, Ted. So could you walk us through what would happen if an investor wanted to invest, say, $200,000 and own 20% of the company? And assuming you agreed to that, how could that go? Like what things could happen?
Yeah. So if you agreed to that, if they were selling stock, what that would mean is $1 million post-money valuation, right? Because $200,000 is 20% of $1 million. And so if you were doing a stock deal, you would essentially be issuing, be both authorizing and issuing enough shares of stock to give them 20% of the company. And it would be on some of those negotiated terms that I was talking about in terms of a liquidation preference and things along those lines. If you were talking about a convertible note or a SAFE, what we're talking about now is a cap, right? And depending on if it's a post-money SAFE, it would likely be, once again, $1 million cap. And the convertible note, I just need to do the math and look at the mechanics of the note because convertible notes aren't always clear on conversion, but it would be a set valuation cap in both of those instances. And it's a great example because, let's say you have an investor that says, I want 20% of the company for 200,000. And in your mind, you're thinking, well, I've got a company here that, in no time, I'm going to be able to have a $20 million valuation, right? And once I get beyond this initial work that I have to do, which is why I'm bringing in the $200,000. If that were the scenario, it's exactly what I'm talking about on the earlier slide in terms of having a low cap and that dragging your future valuation. So in that scenario, I would look at this and I'd say, well, that cap is too low. If you have $1 million cap, it's going to be very difficult for you to get a $20 million valuation in your next round. And I might push in that circumstance the company to try to take on stock, the Series Seed stock, rather than a convertible debt, because I think, in my opinion, it'll have an easier time saying, well, that was an early stage investment. They got a different security than you did. They're not getting the same security. And look at everything that I've done in the interim, as opposed to the situation with a convertible note or SAFE, where they're actually getting the same instrument at that significant discount. Does that answer that?
Thank you.
Yeah. Yeah. And any other questions, or shall I keep on going?
Yeah, I think there was a question also about the fact that you were saying, look, try really hard not to have a zillion different investors, because any investor can be tricky. And so the question is, look, if you go out to a Kickstarter and you've got like a zillion at this point, is that a good idea, or how do you think about that?
So we're not all that fond of crowdfunding. We usually run into problems with crowdfunding. I actually am dealing with a scenario right now. I'm not going to use any names, but where the founder of our company was told that there would be a single entry on the cap table for the crowdfunding. But in fact, there are 60. And we're in a situation where they're in SAFEs. Our new round of investment has required them to convert, and we can't get them to convert because the platform is unable to convert them for the next 3 or 4 months. And so, there are a lot of reasons why we don't like crowdfunding. One being the large number of investors that you're bringing on board. Two being that it's usually quite expensive money. The compliance is more expensive, and you're paying a platform as well. And then three, sort of the headaches that you're dealing with down the road. All of that said, we have clients that do it because that's the only thing that they can do at the time, and it's their best alternative. And if they are going to do that up front, I would work to try to get all of those investors into a single roll-up vehicle or under a single custodian, so that you're only dealing with that one entry on the cap table. And I would shop around and try to make sure that I was using the best platform that I could for that.
By the way, I'll also mention certain angel groups do the same thing, where you have individual investors with their individual. So when you're looking at angel groups, same thing can happen.
Yeah, and we've learned that lesson the hard way, Annette. we've seen angel groups not only have a group of investors that you have to obtain signature pages from each of them, but they a lot of times will have company counsel do it. So we're going around chasing around these people for months to try to close. And then obviously, as I mentioned earlier, the costs involved with future maintenance goes right through the roof. Anything else, or shall I kind of go on?
Keep going on, I think.
All right. Shadow securities modification. This is something quite frequently overlooked in convertible notes. It actually helps with one of the problems that I talked about earlier in terms of the convertible notes being transferred into the same security as the next round. What a shadow security does is it reduces the liquidation preference down to the level of the money paid in by the convertible notes. And it sounds really technical, but just keep in mind that future investors will like if you have shadow securities associated with your convertible notes. So that's a good thing for the company. The SAFEs already have it built in, so you don't have to worry about it there. In terms of areas where founders get tripped up on Series Seed, valuation I already mentioned, size of investment, number of investors, I've already mentioned, except here you want to make sure that you've got enough committed capital to pay the additional costs associated with a stock investment. And then these other points are sort of other nightmares I've run into. I've had situations where investors on a term sheet have agreed to use the very simple Series Seed preferred documents. We've drafted them, gotten them to the investor, and then we get a markup back from their lawyer that says, no, we want to use these NVCA. You may have heard of that style documents. They are the gold standard for Series A and larger equity investments, but they're very complicated and overly complicated for a Series Seed investment, and they're going to blow your budget essentially on that Series Seed investment. So if you do end up doing a Series Seed, make sure that people are going to stick to the terms. They're not going to vary too far. If they're familiar with the documents, in my experience, they stay very close and you can get it done at a good price. The other areas, that I've seen, founders get tripped up on are, and these are related, protective provisions and board seats. Protective provisions are things the company can't do without consent of the holders of the Series Seed stock. Obviously, we want to limit that to as few things as possible, but there's some negotiation that goes on there where investors say things like, oh, we're your friend, so we're going to do what you need to do. And that's usually true until they're not, right? And then once they're not, you could be stuck not being able to do some things that you think are very important towards the growth of the company. Board seats I put in there because I usually push back on too many board seats. While it's true that board seats are going to get negotiated in the future and future rounds of financing, I just try not to have an overly cumbersome large board. So I might be willing to do 1, maybe 2 board seats for investors, but I really try to limit it to 1 or none, and actually have what's called an observer seat, where the investor has the ability to designate someone to sit in on board meetings and see what the board members see, but not actually vote on matters relating to the company. And then the other area of concern that we see are what I'll call preemptive rights. And this is one that founders get tripped up on a lot, because they look at them differently than I would, or potentially other future investors. And to start, preemptive rights is essentially a right of the investor to participate in the next round of financing. As I mentioned earlier, it is completely fair to allow investors to participate, but there need to be limitations on it. First off, if you have a lot of investors, you don't want to give them all these preemptive or pro rata rights, because you're gonna have to chase around and get them before you're able to bring in the new money, and you have to get them to either invest or to waive investment, and that can be a real administrative hassle and can be prohibitive in terms of trying to quickly close your next transaction. But also, if you're giving up too much of the round of financing by giving it to the current investors, there won't necessarily be room to bring in larger strategic investors in the future who want a bigger chunk of the company. So that's the kind of other area where I really start to see some issues. Any other questions?
I think we're good. We're good for now. Wait, here we got one here. Is there a threshold size of investment observer versus voting board position? By the way, we could do a whole session on boards of
Yeah.
directors.
Yeah. It depends on the size of the investment and where the company is going. I could throw numbers out there. I've seen, for instance, this sort of major investor threshold is what it's called. And those major investors a lot of times will get the right to participate in future rounds and will have the right potentially to designate a board seat. And I've seen that more recently in the $150,000 to $250,000 range, when we're talking about, maybe a $500,000 total investment. But obviously, if you're talking about a much larger investment, then those numbers are going to go up. And depending on the number of investors that you have, if all of your biggest investor is 30,000, right? Then you might need to set a different threshold depending on what those investor demands are. Anything else?
We have about 6 minutes left. We've got another question about how to channelize investments. Hold on. Channelize investments for tech companies, for example, like hiring smart engineers versus building a data center infrastructure. Not sure I completely understand that, but in other words, how to channelize investments for tech companies.
Yeah, I'm not sure I'm tracking on that one either.
Prasanta, do you just want to open up your mic and talk?
Yeah, sure. Yeah, the main question is that you have X amount of investment, and then in tech companies, you need a certain infrastructure, and those are generally expensive, either cloud or you want to build a data structure, or sometimes like dedicated server room, for example, that needs like security. One of the decision becomes like, hiring people like, smart engineers are very expensive. And also you need the, data center to operate as well, because you're processing at scale data processing. That's what I'm doing right now, in fact. So like, I think, is there like a rule of thumb that how do you balance the both? Because both are in demand, and then where do you prioritize?
Yeah. So from the investment side of things, I should step back for a second here. One of the strategies that you should have for a company when you're taking on investment is to make sure that you're taking on sufficient investment to have a long enough runway, meaning you can keep on going long enough based on your projections until you get to a higher valuation point. Do you know what I mean by that? Yeah, because one of the biggest issues that we actually see, and I probably should have brought up here, is that a company, maybe they don't like the valuation that they've gotten from their early stage investors, and maybe they don't take on as much money, and they don't have enough runway, and they find themselves having to go back to the well with those investors. And when they do that, they're at a severe disadvantage because the value of the company hasn't gone up. And those investors typically demand more. Now, why am I getting into this? You probably figured it out. But every company should have its own projections as to what those expenses are. And the investment is typically agnostic as to what it's going to be spent on, with some exceptions. Like a lot of times investors early stage aren't going to want to pay the founders a big salary, right? Because they don't want to see them necessarily just be paying the founders to try to build something that the founders excited about. They want to see growth in the company. But point being that, as you're discussing the investment, typically you're going to be providing that investor with some projections, and those projections will be estimating, what those various costs are going to be in terms of infrastructure, in terms of hiring. And that's where some of the priorities are going to come out. If you're dealing with convertible securities where the investors really don't have much say in what the company's doing, after that, you use those funds however you wish to allocate amongst those resources. But hopefully you're allocating in a way such that you're maintaining that runway and maintaining a long enough runway so that you can get to a point where you can actually go out again and demand a much higher valuation of the company. Does that answer the question?
Yeah. And Ted, we just have like 2 more minutes. So a really good question says, any recommendations you might have for reading materials for a young founder to structurally learn about fundraising? And by the way, one thing, again, we've proven today is you need to seek the advice of somebody like Ted, if not Ted, because this is complicated stuff. And you're all about running your company and figuring out your markets and, go to market, et cetera. This is stuff that you need to have an understanding of. But at the end of the day, you really need to be working alongside a professional like Ted.
Yeah, I can't think of any specific reading to look into, but I can get back and try to think of some resources. But there are a lot of online resources that will tell you sort of where the trends are in the marketplace. Like if you look at AngelList and some of these other places, trying to get an understanding of, okay, what are the trends in terms of not only investments and size of investments, but the terms. And as it relates to SAFEs, as well as the Series C documents, especially SAFEs, Y Combinator, if you go to their website, they've got a great description of SAFEs and why you'd want to use them. And I would certainly recommend, going to the Y Combinator website. I can also, if helpful, I can provide some form term sheets. It's one thing that I was thinking about attaching, but maybe we send them to those in the group who are interested to see them. There are a lot of term sheets out there that give a good description of the terms. Some of these you're not going to understand. I like one that I already mentioned, NVCA, the National Venture Capital Association. They've got some pretty good publications, but they also have form documents, and they have detailed notes in those documents that really get into the terms of the preferred stock and, why the company may want something and why an investor might want something. But I mean, all of this, you do need someone to sort of pull this together and synthesize it. And so to Annette's point, we do recommend, seeking out legal counsel. The other thing that, as I mentioned earlier, doesn't come up in any of those materials is the fact that you need to comply with the securities laws. And so I'm going to reiterate that because that is something that's needs to be done in a very timely way, like within 15 days of closing on your first investment. And a lot of companies miss it, and they potentially expose themselves to future liability as a result.
Exactly. So with that, we're right at the top of the hour. Ted, can we get a copy of your slides that you're interested in sending out, and we'll make sure those are passed around. We'll also be sending out a recording of this. Give us a day or two. And want to thank everybody for joining us today, especially thanks to Ted. And you're a wealth of knowledge, and I could actually listen to you all afternoon. So
you're very kind.
going on, but thanks so much.
Thank you.